Hey everybody, today I am bringing you another practice exam question video for your life and health insurance exam. My goal is to help you pass on the first try. I've helped hundreds of thousands of people pass their life insurance and health insurance exams on the first try. I'm an approved continuing education and pre-licensing provider nationwide. So let's get into this. Let's rock it out. Let's go through some of these practice questions. If you have any questions or feedback or concerns, just drop a comment in the description of the video and I'll be more than happy to help you. This video applies to you regardless of whatever state you live in. So if you're thinking right now, does this apply to my state? Yes, it does. I don't care what the name of the state is. This applies to your state. Now, these questions we're taking using real questions from real state exams and processing them through AI to mimic the question structure, style, word count, content, context, everything else that is made in those real exam questions. So these questions that we're going over here are as close to the questions on your actual pre-license exam that it's going to get. This is just a little taste. I'll go into it a little bit later on, how you can get access to more. So question number one, Q1. Which of the following is a key characteristic of an ordinary whole life insurance policy? Premiums increase every 5 years. Coverage expires at age 65. Premiums remain level for life. That's it. Premiums remain level for life. And cash value is not included. That is not true. So premiums do not increase every 5 years for an ordinary whole life policy. Coverage does not expire at age 65. You have coverage until age 100, at which point the insured gets a check for the face amount of the policy if they're still alive at age 100. Ordinary whole life features level premiums, lifetime protection, and cash value growth. Premiums do not increase, and coverage does not expire at age 65. Question 2. All of the following are features of an ordinary whole life policy except provides lifetime coverage. No, it does provide lifetime coverage. Premiums were made level, so that is not the except. You're going to see questions like this on your pre-license exam where it says except. So it's just worded in ways that might try to trip you up. Builds cash value or expires after a set term. Whole life does not expire after a set term. Unlike term policies, it provides lifetime protection with level premiums and cash value accumulation. Okay. Limited pay and single premium life. Moving on to the next questions. Limited pay life insurance differs from ordinary whole life because, so now we're looking here, what is the difference between limited pay life insurance and ordinary whole life insurance? Limited pay is a whole life policy. Coverage ends once premium stops. That's not true. Limited pay policies, coverage keeps going after the premiums stop. Premiums are paid for a shorter period. That is correct. Limited pay policies require premiums for a set period, like 5 years, 10 years, 20 years. Or even they might end at a certain age. Sometimes people will get limited pay policies that are paid up at age 65. So that means at age 65, the insured no longer has to make payments. Why would they do that? Well, people retire at age 65. So it makes sense to not want that payment as part of your retirement plan. Limited pay still builds cash value, and it can be used for estate planning. So the difference is in a traditional or ordinary whole life policy, premiums are paid until the insured dies or reaches 100 years old. In a limited pay life, they pay the premiums for less time. Okay, so they pay their premiums for less time, but because they're paying it for less time and the policy still continues, they have to pay the cost of insurance in a shorter amount of time, so their premium each year is higher. So they pay more in a shorter amount of time than they would pay in that same amount of time with an ordinary whole life, but they don't have to keep making payments after. And a key point of that is the net amount paid is usually less. So like if someone has a policy if someone lives to 100 years old and they had a 20 pay life versus an ordinary whole life, they would actually have paid less total premiums in the 20 pay because they front load those premiums so that the insurance company can still make interest off that. Okay, next. Which of the following is not true about single premium whole life? This is another one where we have the accept versus not true. So what you're going to look at for these is in the not true questions, you're going to say, hey, which of these are true? Sometimes it's easier to mark all the ones that are true, right? Because it's like an extra step for us to process which ones aren't. So which is true? The policy is fully funded with one payment. Well, that's true about single premium. Cash value is available immediately. That is true about single premium. Requires annual renewal premiums. Well, single premium is just one payment, so there's no annual renewal premium. So we know that that's the one that is not true. And then coverage lasts for life. It does last for life. So single premium whole life policies require only one lump sum payment at issue. They do not need annual renewals. If these questions are helping you now, or if you feel like you're learning a little bit, or even learning about the style of questions that you're going to encounter on your pre-license exam, check out the packages that we have available for studying, our study packages, in the description of the video. I've helped, like I said before, I've helped hundreds of thousands of people literally pass their insurance exams, and you can be one of them too. They are the best pre-license prep packages out on the market today. From the videos to the practice questions, there's hundreds of practice questions like this in there that mimic your state exam. Even the state laws, you learn your state law is easier. I took this material and I made it way easier to understand because most courses out there are so brutally boring. Make it exciting. I make it interesting. There's so much content, AI tools, all that stuff, flashcards, live sessions, all that. So click on the description of the video if it's something that interests you. And if not, no problem. Universal life. So what makes universal life insurance distinct from whole life? So in these types of questions, there are comparison questions where they'll be comparing one type of insurance or one concept to another. So this is really where knowing the concepts is important. It's not always just about memorizing the questions that you take on your practice test. It's about understanding the concepts. That's really what I try to teach people. So no cash value is available. Well, universal life and whole life both have cash value. These are things, this is conceptual, right? This is you can really only know this from knowing the concepts. Premiums and death benefit are flexible. So that is true. So this comes from knowing that whole life has fixed premiums, like we covered before, and universal life has flexible premiums. The policy must be paid in one lump sum. That's not true. And it provides term protection only. So that is not true as well. Okay. In a universal life policy, the cost of insurance is deducted from the policy's cash value. So each month, the cost of insurance and expenses are deducted from the policy's cash value account. So there's a cost of insurance at monthly deductions that's built into a universal life policy. And those monthly deductions are taken from the cash value. The insurer's general account, that's not the answer. The general account, in the insurer's general account is where premiums are invested if it's a fixed plan. So remember, there's variable plans. We'll cover those next. Variable plans, the money is invested in equities or the mutual funds, and it's called a separate account. The insurer's general account is where fixed interest products are. Policyholder salary, nope. And dividends, no. Okay. Variable whole life. So which feature distinguishes variable whole life from traditional whole life? Guaranteed fixed interest rates. So variable whole life, if it said which feature distinguishes traditional whole life from variable, well, there is a guaranteed fixed interest rate on a traditional whole life, but in variable life, because the money's invested in the separate account and it's invested in the stock market, it'll go up and down. Cash value invested in separate accounts. So that separate account is what I was talking about before. That's true. That is what distinguishes that is one of the distinguishing features from variable whole life to traditional whole life. There is still a death benefit, so that's not right. Both of them have death benefits, and in neither of them do premiums increase annually. So neither of these policies have annually increasing premiums. So variable life allows investment of cash value in separate accounts like mutual funds with potential for higher returns but no guarantees. Next, a producer selling variable whole life must hold which licenses? Life insurance license only, securities license only, both life insurance and FINRA securities licenses. So what I want you to understand is that if someone wants to sell variable products, meaning products that are invested in the stock market, like variable whole life, variable universal life, or variable annuities, anytime you see variable and it asks about licensing, they need to have their insurance license and a FINRA securities license. This is because insurance is regulated on the state level. Okay, so your state approves you for insurance licenses, but securities like mutual funds that the separate account could be invested in, those are regulated by the feds. So that's a federal government regulation. Right? No license is not regulated. That's not true. They're both very regulated. So feedback here, because variable products are securities, agents need both a state life license and a FINRA securities license. Okay, variable universal life. So variable universal life, this is a combination between universal life and variable whole life. Essentially, well, I shouldn't even say that. It's really a universal life where the premiums are invested in a separate account. So, but it does combine some features, so they will try to trip you up on your question. So variable universal life combines features of universal life and variable life by offering flexible premiums and investment choices, guaranteed interest rates, only temporary coverage, no cash value account. So it offers flexible premiums and investment choices. VUL policies provide premium and death benefit flexibility like universal life, an investment choice in separate accounts like variable life. Okay. The investment risk in a variable universal life policy is borne by the policy owner. Okay. So in a variable policy, the policy owner takes on the risk of the investment. Okay. The insurance company does not. So the insurance company takes the risk on a fixed policy where premiums are invested in the company's general account. The state guarantee fund, that is something else. The state guarantee fund is where it helps people if insurers become insolvent. So you're going to learn that in your course. It's something different. And the beneficiary. Beneficiaries don't take any of the risk. They're the ones who are protected from risks. So in a VUL, the VUL stands for Variable Universal Life. The policy owner assumes the risk since returns depend on investment performance. Okay. Interest-sensitive whole life. Interest-sensitive whole life differs from traditional whole life because premiums vary based on current interest rates. So interest-sensitive whole life, also called current assumption whole life. So you're going to see that current assumption whole life adjusts premiums and cash value growth depending on current interest rates. So in interest-sensitive whole life, there is a guaranteed death benefit. They do accumulate cash value. They are not a type of term insurance. It's a whole life. Okay. All of the following are true about interest-sensitive whole life except premiums may be adjusted. So there's another one, except. So it's like, which of these are not true about interest-sensitive whole life? Premiums may be adjusted. They cannot be adjusted. Cash value growth depends partly on current interest rates. Okay. So cash value growth depends partly on current interest rates. Coverage is guaranteed for life. Or premiums never change regardless of interest rates. That's true. So unlike traditional whole life, interest-sensitive whole life allows premium changes if interest rates fluctuate. So interest-sensitive whole life allows for premium changes if interest rates fluctuate. Okay. Meaning if the interest goes up and it's earning more money, premium could lower. But if the interest goes down, the premium could raise because it's not making as much of a return for the insurance company. Okay, indexed life. Which of the following best describes indexed universal life, also known as an IUL? So death benefit tied to the stock market. Anytime you see stock market or mutual funds or equities or securities, that is a variable product. So a variable whole life, variable universal life, variable annuity. Cash value growth tied to a market index. So market index is different than a mutual fund. Okay, so market index, when in an index policy, it has some upside of the market without the risks. So say in an index universal life, say the minimum interest rate would be 2%, but the maximum they could earn is 8%. That means if the market earns 10% that year, they get an 8% on their policy, but the insurance company keeps the difference, the excess. Okay, so it's not like it's directly there because there is a guaranteed minimum and then there is a maximum that they can earn. So it's based on an index, so it's like a reflection of the market rather than directly in the market where this is exactly what the return is going to be. Premiums are not invested directly into mutual funds. So invested in mutual funds, that's variable. Policy guaranteed to double every 10 years. You can't guarantee anything like that, especially a variable product. That's an easy way to lose your license. Guarantee that a variable product will have a certain return. No. So feedback here, indexed life links cash value growth to a stock index like the S&P 500 with caps and floors to balance risk and return. 14. In an indexed life policy, if the stock market performs poorly, the policy always loses value. Not true. It has a minimum rate. The insurer reduces the death benefit. That's not true. It has a guaranteed death benefit. The policy's cash value is protected by a guaranteed minimum interest rate. That is correct. So index policies provide downside protection through a minimum guaranteed interest rate while still allowing growth when the index performs well. Okay. Accumulation and annuity periods. The accumulation period of an annuity is the time when premiums are paid into the contract. So an accumulation period is when the owner makes contributions and interest accumulates. Payments to the annuitant begin in the annuity period. Income payments are received in the annuity period. So there's accumulation period and an annuity period. I have a ton of videos on annuities, and in my exam prep packages, I really break these down. Very easy to understand. But basically, income payments are received in the annuity period, or annuitization phase is another word for it. The annuity has not matured, and the insurer credits no interest. So interest is credited in the accumulation phase. Next, which of the following is not true about the annuity period? So once again, in the not true questions, you want to look and see which ones are true. Then the ones that are true are the ones that aren't the answer. And then the last one is, that's the way my brain works anyway. I don't know. I'm weird. So the annuitant begins receiving periodic payments. The annuity period is when they receive payments. So that's true. Payments may last for life or a set time. That is true. Premiums are paid into the account. So premiums are not paid into the account during the annuity period. They are paid into the account during the accumulation phase, not during the annuity payout phase, right? And then the insurer calculates payments using mortalities and interest factors. So that's done before. That's done like when the annuity is created. Purchased, I should say. Okay, payout options. These are annuity payout options. Which payout option guarantees income for as long as the annuitant lives? If you've taken your test before, you know these are pretty dang close to what you're going to see on the test. So I hope this helps a little refresher, because now you're seeing them and you're not like in that exam environment where you're freaking out anymore. Which payout option guarantees income for as long as the annuitant lives? So it's life only. So life only or straight life is another one they call it. Straight life or life only. Cash refund is not it. Cash refund is when they elect a cash refund option. That means that, say they paid $100,000 into the annuity during the accumulation phase, and in the annuity phase, say they've received $50,000 and then they die. The cash refund means that that additional $50,000 that they paid in that they haven't gotten paid back yet goes to the beneficiary. Period certain means they're going to get money for a certain amount of time. And joint survivor, those are the policies where the annuities where payments continue to a spouse after one dies. So a life-only payout provides maximum income but ends at death with no beneficiary payment. So that's the big risk too on the individual, right? They're saying, hey, give me as much money. Like, I'm going to do straight life when I die. No one keeps getting the payments. If I live a long time, they win. If they don't live a long time, the insurance company wins. All right, so a retiree selects a 10-year period certain annuity. So 10-year period certain, that means they're going to get payments for at least 10 years. If they die in year 4, the insurer will keep all the unpaid funds. That's not true. That's in straight life or life only. That's what happens in life only. Continue payments to a beneficiary for 6 years. So period certain means for a certain period of time. So the 10-year, I'm going to select a 10-year. So for a certain period of time, which is 10 years here, I'm going to receive payments. And if I die before that period of time is over, then the remaining payments get sent to my beneficiary. So the payments would continue for 6 years. Refund only the premiums paid, not true, and then pay nothing further, and that's not true. Okay, we're going to look at combination plans and variations. So we're looking at joint life, first to die. All right, joint life, first to die. Joint life insurance pays benefits when the last insured person dies. No, that's survivorship life. So survivorship is when the second person has to die. Survivorship, second to die. Easy way to remember is survivorship has an S, second to die has an S, so survivorship, second to die, SS. Joint life is first to die. So it's when the first insured person dies. A joint life policy pays out upon death of pays out on the first death, making funds available immediately for surviving dependents or business partners. Next one, a husband and wife buy a joint life policy. If the husband dies, the wife will receive the death benefit. So that's just what we covered there, pretty straightforward. And then we'll do one of the survivorship life questions too. So survivorship life insurance pays benefits when the first insured dies or the second insured dies. That's it, because survivorship life, remember, survivor, second, life pays after the death of the last insured, often used for estate planning or taxes. This is a good one. So this shows comparison of a few different types of policies. So all of the following are uses of survivorship life except estate tax funding. It can be used for estate taxes, for sure. If a husband and wife have a lot of money and they pass, they want to make sure that their estate taxes can be covered by life insurance. They still have to pay the tax, but the life insurance gives the money back. Providing funds to heirs. All life insurance policies can do that for the most part. Covering mortgage loan. So mortgage loans are typically covered by what type of policy? Decreasing term life insurance. Okay? So decreasing term life insurance is what those types of policies typically cover a mortgage. Okay, last question here. And by the way, like I said before, if these questions are helping you, I literally have hundreds of these questions. If you can see these Pearson VUE style questions, I have a few exams there. And I have more than that in the course. I have 5 to 6 exams for your state, and there's hundreds of questions that each exam pulls from. So each exam's 100 questions long. And there's 5 or 6 of them, but every time you take it, it refreshes. That's just like one part. But anyways, these will really, really, really help you get used to the question styles that you're going to encounter on the exam. For me, it's an absolute no-brainer to study these types of questions. Waiver of premium rider allows the insurer to forgive the premiums if the insured becomes disabled. So the waiver of premium rider keeps the policy in force without payments if the insured is disabled, usually after a waiting period. All right, well, I hope that helped you. I'm going to pick up on where we left off here on the next video on practice exam questions. You're going to want to watch the next video coming up, though, because there's a ton of more practice exams covered, or practice questions covered in that video. So click on the video here. It's also in the description of this video if you want to find that link, but it should be popping up on your screen right now. Thank you so much. Subscribe to the channel. Don't forget.